Well, hi, it's Chris here from Capital Counts and welcome to another Meet the Fund Manager investment series. Today I'm kindly hosted by Betasahres again and their Chief Economist, David Bassanese. Welcome.
Good to see you again. Yeah,
thank you for having me. Betasahres, for those of my viewers that don't know, managed $40 billion this week, in fact. So it's in funds under management, which is a great result. They specialise in exchange-traded funds, ETFs as they're coined, across all the asset classes, fixed income, cash, Aussie shares, international shares, and also get into AI, ESG, and various other assets. So today, David, obviously markets have been very, very buoyant, pretty volatile. We've had great end of financial year results, but we've still got headwinds. Still got geopolitical issues. Inflation's high, albeit coming down. Interest rates across the board high, also coming down, but maybe might pop up here in Australia. So I'd be interested in your thoughts there. So I've got a couple of questions for you as we lead into this new year. Obviously, I want to check the temperature because clients are sort of feeling, well, is it too toppy? Is it going to come off? Those sort of things. So what have been the recent developments in markets?
Look, I think first and foremost, the sort of so-called soft landing scenario, the big debate over the past few years is, can we get inflation down from the COVID highs without a recession, a global recession? Will central banks need to generate a recession to get inflation down? And the good news is that it is still playing out the soft landing. We're seeing inflation in the US continuing to come down. There were a few hiccups earlier this year. In the first early months of the year, we had a few US inflation numbers which were a bit higher than expected. The markets priced out any risk of US rate cuts. Markets had a bit of a correction in April, but the numbers in more recent months have been good again. And the market's now saying that the Fed can cut rates potentially as early as September. So that's good for bond yields. They're coming down, and that in turn is supporting the equity market. Economic growth is holding up globally, particularly in the US. Corporate earnings are good. So, you know, the backdrop is still very encouraging. The soft landing scenario that we've been hoping for over the past couple of years is still playing out. And we're seeing that supportive of both equity markets, but also bond markets.
You mentioned interest rates. So September possibly out of the US coming down. Conversely, here in Australia, we're already talking about perhaps going up.
Yes. So not so good news in Australia. So whereas in the US inflation has resumed its descent, in Australia we've had our monthly CPI numbers have ticked up. So the issue in Australia was that we have a quarterly CPI, which used to be the old reliable thing we always looked at. But now we have this monthly CPI as well, which is a bit more, it's more timely, comes out, every month, but it's a bit more volatile. And so we've got to take the numbers with a grain of salt. But what they have suggested is that the decline in inflation has stopped so far this year. So we've got annual inflation still running around 4%, the high threes, 4%. If we get the June quarter CPI, which is the most important measure, more important than the monthlies, if that comes out higher than expected or higher than the RBA's forecasts, after the RBA have already revised up their forecast back in May, they'll be under pressure to, potentially have to raise rates. And it all comes back to, at the moment they're saying, we think inflation's coming down. We think it'll be back into the band by end of 2025. Now, and as a result, we don't think we need to raise rates anymore. If it turns out that they had now forecast it coming down more slowly and take it to 26, they may have to raise rates to sort of get it, to have their forecast still having it coming down in 25. So that's mechanically, I think, the way they're thinking about it. But bottom line for investors is that the inflation story in Australia, at least in the short run, hasn't been as good. And there is a risk that the RBA, my base case is they won't raise rates, but it's probably a 30, 40% chance that they do. It does depend on that June quarter CPI and how bad it is, and then obviously how the RBA react to it. Can they look through it or not?
Well, let's hope they don't for us mortgage holders, but it's probably not too bad for deposit holders.
Yeah, it depends if you're a borrower or a lender.
Exactly. The US presidential election, it's hot on everybody's lips, obviously with Biden's resignation. What's the impact?
Look, at the moment, the markets with Biden there was like, I think 80-90% chance that Trump was going to win. That's what the polling was suggesting. Biden having stepped aside, the probability of Trump winning is a little bit less. She's a bit more of well, at least in some circles. The Democrats thought enough to get rid of Biden to replace, they did that only because they thought she would be a better chance of winning. But bottom line, the markets are still think that Trump's a good chance of winning. What does this mean for markets? There's a thing now being talked about, we talk about soft landing, we talk about the other thing going on as a great rotation when we get into that. Next question. But at the moment, the thing about Trump is the so-called Trump trades.
Yes.
What is a Trump trade? Yeah. Donald Trump is in favour of low taxation. He doesn't care about the budget deficit. He's for low regulation. So basically, markets think that the risk of inflation staying high or coming back, deficits remaining wide, which means that the Fed maybe can't cut rates as much as they would have otherwise done. So that's strong US dollar story. It's a higher bond yield story, higher commodity gold prices, for example. So Trump trades at the moment are your longer term bond yields rising relative to short term yields. So like a yield curve steepening, if you like. Strong US dollar and strong gold prices at the moment. So that's the way things are playing out at the moment. The other little aspect to that, even if she doesn't win, if Harris, the new candidate for the Democrats, at least stems the bleeding such that the Republicans don't get a clean sweep if they don't win both. If Trump wins and the Republicans get majority of the Senate and the lower house, then they've got carte blanche to do anything they want, and they could become very aggressive in, cutting taxes and maybe being somewhat disruptive on the policy front. Markets like what's called Washington gridlock. They like it when Washington can't do very much, as in the case of Australia, where if Trump wins and the Republicans don't get the majority in either the Senate or the lower house, then that's probably good for markets as well because it'll limit what Trump can get through in terms of policy.
So you did actually mention great rotation just then, and there does appear to be a broadening of equity markets. So like across the board, large, mid, small caps, and perhaps some good opportunities in the small caps with some earnings. And from what I'm seeing anyway, is some of those companies perhaps are trading at a discount, to the historical averages. So is there sort of some opportunities in there that we should be looking at?
Yeah, look, I think the US large cap tech companies, the Mag 7 or the Mag 4 or however you want to, used to be called the FANG stocks, but basically large cap US tech companies have been dominant for a long time. They've been outperforming. They look relatively expensive to everything else. In their own right, maybe not super expensive, but certainly more expensive than other parts of the market. And we have seen some glimpses of a rotation. Now, one of the aspects of that is everything looks so good that people can afford to take on a bit more risk out of the more dependable large cap tech companies, and as you mentioned, the smaller caps, the emerging markets. So it could be that even in this soft landing environment of falling bond yields, okay economic growth, which normally favours technology, as we've seen in the years leading up to COVID. But it could be that the environment is so good that people then actually look beyond them and look elsewhere. And the other thing I think that's playing into this is, again, going back to Donald Trump, potential or even US generally, even under Biden, we're seeing more restrictions on sales of semiconductors to China, potential trade wars that could disrupt trade. And so that's another thing playing on maybe the tech companies at the moment. NVIDIA, great company, great story, trading at very high valuations. So
every second person I speak to talk about that rise.
Yeah. So look, there is definitely, but the thing about things can look cheap for a long time, and you can sit there and wait. Well, it's so cheap. Why is it? But if it doesn't move, you're not going to get a return. So, but as you mentioned, we are starting to see that. I actually think there's a pretty good chance that, given the global backdrop remains so good, that people do start to rotate into some of the other areas of the market, the great rotation, as it's being called.
China, sluggish or not, and the impact?
Yeah, so China's sort of on the back burner at the moment in terms of global markets. It's not doing enough to excite people. Like growth is sort of plodding along, at least in Chinese terms. 5% growth for China is plodding along. They're not announcing big fiscal stimulus packages to boost growth a lot more than what you're getting. But it's nor is it weak enough to have people running for the exit sort of thing. So China's just doing enough to sort of keep the economy ticking over, and it's sort of on the back burner in terms of issues. So we've seen some economic growth numbers, which a little bit disappointing, but not too bad. Economic growth running at about 5%, and just more broadly, what we're seeing in China is the property sector, is weak. They've had a major property bubble that's burst. Consumer spending is soft because people's wealth is tied up in the housing market. It's not them making them feel too good about that. But meanwhile, infrastructure spending is the government is still spending a lot on infrastructure. They're becoming leaders in green energy, electric cars, solar panels, batteries. So China is a major contributor to climate change in terms of its emissions, but is actually a major contributor to the solutions as well in terms of manufacturing at the moment. So there is a bit of a transition going on in China in terms of the sources of growth. And overall growth has slowed, but not to a degree that we should get overly concerned.
And the Aussie dollar?
Aussie dollar, look, it's waxed and at the moment it's going, at the moment we've got short run expectations of the RBA potentially having to raise rates, increased expectations that the US Federal Reserve can cut rates in September. So the interest rate differential has widened in favour of Australia, and which makes it more attractive to invest in the Aussie dollar relative to the US dollar. So we've seen the Aussie dollar, get up to the mid-high 60-cent range, which is consistent with my forecast in that over the next year, I've been long of the view that the Fed we would both cut rates, but the Fed will cut rates by more. Why? Because they raise rates by more. So they've got more capacity to cut rates on the downside. And as a result, the way the Aussie weakened during the rate cutting, the rate hike cycle, it can strengthen during the rate cut cycle that we'll get through with central banks over the next year or so.
And then finally, just are there any thematics that you're actually looking at, strong, and seeing like of your 40 billion in funds under management, where a lot of money is actually being going?
Look, in terms of our flow, Australian market has been underperforming. It's been okay, but it's underperforming global companies. And so, a lot of flow into ETFs is certainly still into global equities. A, because it's a great source of diversification for people that already own Westpac and BHP and whatnot. But B, because it's where the growth is at the moment. Fixed income, a lot more, more and more central banks move toward cutting rates. Last year was the big movement into cash and floating rate bonds. This year, the flows are into fixed rate bonds. Because, if the central banks do cut rates and bond yields fall, you're going to get pretty nice returns on fixed rate bonds. So that's where the flows are going at the moment. And just to your point about the great rotation, some value areas like Japan is looking very good. It's been outperforming for a while, even beyond one of the few areas in global markets beyond large cap tech that's been outperforming. And things like a bit of esoteric one, but there's Standard & Poor's 500 equal weight index. And so that's the US market, but equally weighted the top 500 stocks. So you're reducing your exposure to those big companies. And that's going to give you that small cap bias, which if you do get the great rotation, is really going to, should do better than the overall market in the US.
Okay. David,
No
excellent
worries.
insights as always. For the viewers again, if you need any more information on Betasahres or just an update on your own personal financial situation, give us a call on 1300 882 166, and we'll see you next time. Thank you.
Bye for now.